You know how it is when you try to read an official financial document? Your eyes just kind of glaze over from all the jargon and legalese, but deep inside is the information you actually need. So today, we're going to crack open the rulebook for the Bandhan Gold ETF. We're going to break it down slide by slide and see what really makes this thing tick.
So here's our game plan. First, we'll tackle the big idea behind it all. Then, we'll see how it actually invests your money. After that, we'll get into the nitty-gritty of buying and selling, uncover the costs, and finally, we'll look at the big risks you really need to be aware of. Let's dive right in.
So you might be asking, why do we even need something like a gold ETF? Well, think about it. If you wanted to own actual physical gold, you've got to worry about where to keep it safe, right? Is it even pure? And don't get me started on the hassle of actually buying and selling it. Yeah, a gold ETF, it's built to make all those problems just go away. And the solution has a name. It's called an exchange-traded fund, or ETF for short. The idea is actually pretty simple. Just picture a giant basket full of gold. Now, imagine that basket is split into millions of tiny little shares, and you can buy and sell those shares right on the stock market, just as easily as you trade a stock at any big company. It's that simple.
Okay, so with that basic idea in our heads, let's zoom in on our subject for today, the Bandhan Gold ETF. What's its whole purpose? What's it really trying to do? At its heart, its job is super simple. It's just supposed to track the price of physical gold here in the Indian market. The best way to think about it is like a shadow. It's not trying to beat gold, it's not trying to outsmart it. It's just designed to follow its every single move, whether that's up or down. And if you look at the official document, this is exactly what it says. The goal is to match the domestic price of gold. But, and this is the really important part, look at that fine print. See those words? Before expenses and subject to tracking errors. Those little phrases are absolutely key. They're the reason the fund's performance isn't a perfect 100% mirror image of gold's price.
So when it comes down to it, how do we know if this fund is doing a good job? Well, it's measured against just one thing, the domestic price of physical gold. That's its benchmark. The closer the ETF's performance gets to that benchmark, the better it's doing what it promised to do. So the big question is, how does it actually do that? How does it follow the price of gold so closely? Well, let's pop the hood and take a look at the engine inside, the actual mechanics of this thing. Okay, this is a really important detail. This fund is passively managed. What does that mean? It means there isn't some hotshot fund manager in an office making big bets on where the price of gold is headed. Nope, the job is simply to follow the price. Think of it as a follower, not a fortune teller. And if you look at how the money is actually split up, it totally confirms this. Look at that. Almost the entire pie, we're talking 95 to 100%, is in physical gold or things that are basically gold. That tiny little sliver of cash you see, that's just for day-to-day stuff, like paying the bills. The focus here is gold, and more gold. And they're super specific in the document about the kind of gold we're talking about. This isn't just any old gold. It has to be at least 99.5% pure, which is, international standard stuff. Sure, it can use some other gold-related instruments, but the bedrock, the whole foundation of this fund, is actual, high-quality, physical gold bullion. All right, so that's the theory behind it. But what about the practical side? How do you actually get your hands on this stuff? Let's talk about the process of buying and selling units. So there are basically two different lanes here, depending on who you are. For most of us, for retail investors, it's super simple. You just buy and sell units on the stock exchange, the NSE or BSE, through your regular broker. It's exactly like buying a stock. But then, for the big players, the huge institutional investors, they have a special direct line to the fund itself. They can create or cash in these massive blocks of units, totally outside of the regular stock market. And one quick but important thing to remember, this is all electronic. We're in the 21st century. Your units live in what's called a demat account. So yeah, forget about any old school paper certificates. Everything happens digitally. Okay, now for a topic that, let's be honest, is one of the most important for any investment, the costs. Because every little fee is money that's not in your pocket. It directly eats into your returns, so you absolutely have to know what you're paying. The big one is called the total expense ratio, or TER. Think of this as the annual management fee for running the whole operation. Now, the document says the absolute maximum they can charge is 1% a year. It's good to know, though, that the actual fee they charge is usually a bit lower than that ceiling.
Then, on top of the fund's own fees, there's a tiny little government fee called stamp duty. It's just 0.05% every time you buy. And here's some good news, especially for us retail investors. There is no exit load. What that means is the fund itself won't hit you with a penalty fee if you decide to sell your units on the stock exchange. Now, you'll still have your usual brokerage fees, of course, but there's no extra goodbye fee from the fund.
And that brings us to our last, and you could argue our most important section, the risks. Look, every single investment has them, and this document is pretty upfront about them. So let's get into the big what-ifs that you really need to think about.
Okay, number one, the big obvious one, the price of gold itself. This ETF is built to follow gold, period. So if the price of gold takes a nosedive, guess what? The value of your investment is going right down with it. There's no magic safety net here.
Hey, remember that term we mentioned a few minutes ago, tracking error? Well, here it is again. This is the risk that the fund's return won't be a perfect, exact match to the price of gold. There's always going to be a tiny little gap, and that gap comes from things like, well, the fees we just talked about, and that little bit of cash the fund needs to keep for expenses. And this right here, this is the other side of the coin when it comes to passive management. On one hand, it keeps costs nice and low. But on the other hand, it means the fund is basically on autopilot. If gold prices are in a freefall, the fund isn't going to step in and try to stop the losses. It's required to just follow the price, all the way down, for better or for worse.
The document also points out a few other things to be aware of, like what if there's low demand and they have to sell gold at a bad price? What about the actual physical risk, that the gold itself could get lost or stolen? And then there's the one you can never predict. The risk that the government could just change the rules or taxes on you.
So there you have it, a full tour of the Bandhan Gold ETF, using its own official document as our guide. We've looked at what it is, how it's put together, what it costs, and the risks involved. Now remember, our whole goal here is just to break things down and make them clear. This isn't about giving advice. We've given you the facts straight from the source. So the real question to end on is this. Now that you have the facts, what questions does it make you want to ask next?